Hey guys, welcome back to the Bitcoin Fortress podcast. Today is Sunday, August 2nd, 2026. We are recording at block height 960749. Moscow time is 1584 sats per dollar, and recommended fees are still exceptionally low at approximately 1, 3, and 3 sats per virtual byte. Bitcoin is trading around 63,000 as I record this. We remain nearly 50% below the October 2025 high, and the mood could not be more different from where it was less than a year ago. Back then, everyone wanted exposure. Now, the institutional enthusiasm has cooled. ETF flows are inconsistent. Bitcoin treasury companies are being tested. Mining economics are deteriorating. Regulators are trying to pull the wider crypto industry deeper into the traditional financial system. And this week, Bitcoiners received a brutal reminder that self-custody hardware is not the same thing as a complete security model. It was a difficult week, but it was also an unusually important one. The bear market is stripping away the marketing and exposing the underlying structures. We are learning which businesses were built to survive, which financial products depend on permanent access to cheap capital, which hardware assumptions deserve to be revisited, and which institutions actually understand the difference between Bitcoin and the larger speculative crypto casino. That is exactly the kind of environment where we should be paying attention. This week, we'll cover the Coldcard vulnerability and the resulting thefts, Strategy's changing approach to its Bitcoin holdings and preferred securities, Coinbase's continuing losses, the Federal Reserve's decision to hold rates steady, the deteriorating fiscal position of the United States, renewed debate over the Clarity Act, ETF flows, miner capitulation, the migration of mining infrastructure toward artificial intelligence, the end of BitMEX, European sanctions against HCX, and several other important stories. We'll then take a look at major themes circulating through the Bitcoin podcast universe. Our featured Bitcoin Fortress essay this week is Building Instead of Extracting, week 11 of the Bitcoin Way of Life series. And finally, we'll mention all 4 Bitcoin Fortress books, including the newest release, The Architecture of Money, and a little preview of where the next book may be headed. With that, let's get started. Starting with security, self-custody, and the Coldcard failure. We have to begin with the biggest Bitcoin-specific story of the week. On July 30th, an attacker began sweeping Bitcoin from addresses associated with vulnerable Coldcard hardware wallets. Initial reporting identified approximately 594 Bitcoin stolen in a rapid 25-minute sweep. Subsequent analysis expanded the suspected impact to thousands of addresses and estimated total losses approaching $89 million. Researchers have connected the thefts to weaknesses affecting seed generation in certain Coldcard devices and firmware configurations. The most important distinction here is that this was not a flaw in Bitcoin. The Bitcoin network did exactly what it was designed to do. Valid private keys signed valid transactions. Miners included those transactions in blocks, and the network finalized them. The failure occurred farther up the security stack. The affected users believed their devices had produced sufficiently random private keys. If the key generation process instead contained predictable inputs or insufficient entropy, the attacker did not need to break SHA-256, compromise the blockchain, or physically steal the signing device. The attacker merely needed to recreate the keys. That is a devastating failure because randomness is the foundation of private key security. A private key can be stored offline, protected by a PIN, hidden behind an air gap, and secured by a tamper-evident bag. None of those protections matter if the key itself was predictable when it was created. This story should permanently change the way Bitcoiners talk about hardware wallets. For years, many people have treated hardware wallet selection almost like choosing a sports team. They become emotionally attached to a particular manufacturer. They debate secure elements, open source firmware, air gaps, QR codes, SD cards, and USB connections. Those are all legitimate considerations, but the deeper lesson is that no single hardware device should become the security model. The device is merely one component. A resilient security model includes key diversity, geographic separation, recoverability, transaction verification, documented inheritance procedures, and a plan for replacing any individual component when it fails. This is where collaborative multi-signature earns its keep. In a properly designed 2 of 3 multi-sig vault, one compromised hardware key does not automatically compromise the Bitcoin. The attacker would still need another independent key. That does not eliminate risk. Poorly constructed multi-sig can't create its own problems. Users must preserve wallet configuration information, verify receiving addresses, understand recovery, and avoid placing every key in the same physical location. But this week demonstrated why eliminating single points of failure matters. The correct takeaway is not that Coldcard users were foolish. Coldcard had built one of the strongest reputations in the Bitcoin hardware industry. Many sophisticated Bitcoiners reasonably believed it was among the safest available devices. The takeaway is that reputation is not a substitute for architecture. Any company can fail, any firmware can contain a bug, any manufacturing process can be compromised. Any individual signing device can eventually become obsolete or untrustworthy. The system must anticipate that possibility. This is also a useful reminder that the phrase cold storage can create a false sense of certainty. Cold simply means the key is generally kept offline. It does not tell us whether the key was generated safely, whether backups are secure, whether the wallet software is trustworthy, whether the user verifies addresses, or whether an attacker can reconstruct the seed. Cold storage is a characteristic. It is not a complete security model. For owners of affected devices, the prudent response is to follow the manufacturer's current advisory, identify which model and firmware generated the seed, and move funds to a newly generated key using an independently trusted process. Anyone using the key in multi-signature should consider rotating that key rather than abandoning the entire wallet structure. Most importantly, do not rush through the migration. Panic creates additional mistakes. Verify the destination address on more than one device. Test with a small transaction where appropriate. Confirm recovery materials, then complete the move deliberately. This was an expensive lesson for the people directly affected. The rest of us should make sure it does not become a wasted one. Next up, Strategy faces its full capital structure test. Strategy reported second quarter results on July 30th, and the numbers were dramatic. The company recorded an operating loss of $8.33 billion and a net loss of $8.22 billion, primarily because fair value accounting required it to recognize an $8.32 billion unrealized decline in the value of its Bitcoin holdings. As of July 26th, Strategy held 843,775 Bitcoin with an original cost basis of approximately $63.69 billion and a market value of approximately $54.77 billion. Its average purchase price was approximately $75,476 per Bitcoin. The headline loss sounds catastrophic, but we should separate accounting volatility from liquidity. Strategy did not lose $8.22 billion in cash during the quarter. Most of the reported loss reflected the falling market value of Bitcoin that the company continued to hold. This is an inevitable consequence of fair value accounting. When Bitcoin rises, Strategy reports enormous earnings. When Bitcoin falls, Strategy reports enormous losses. Neither number tells us by itself whether the company can meet its obligations. The more important questions involve cash flow, debt maturities, preferred dividends, access to capital markets, and the relationship between the value of Strategy's Bitcoin and the senior claims sitting ahead of the common stock. That is where this quarter becomes interesting. The bull market version of the Strategy model looked almost effortless. Issue securities at favorable prices, buy Bitcoin, watch the Bitcoin appreciate, and repeat. The bear market version is more complicated. Strategy is now carrying a large family of convertible debt and preferred securities. Those instruments create obligations that do not disappear merely because Bitcoin enters a bear market. The Bitcoin may be permanent capital from Saylor's philosophical perspective. The dividends are not philosophical. They are contractual. Strategy reported that it had increased its dollar reserve to $3.75 billion, enough to cover more than 2.1 years of preferred dividends and interest obligations at current levels. The company also reduced outstanding convertible debt from approximately $8.21 billion to $6.71 billion through a negotiated repurchase completed at a discount. This is a rational and necessary defensive move. Holding dollars may appear inconsistent for a company built around Bitcoin, but liabilities must be matched with liquidity. Strategy cannot pay a preferred dividend directly with an unrealized Bitcoin gain. It needs dollars. The reserve reduces the risk that a short-term market disruption forces the company to sell Bitcoin at its worst possible moment. It creates breathing room and demonstrates that management understands the capital structure must survive a prolonged downturn, not merely a temporary correction. At the same time, the reserve raises an important question. Where did that money come from? Strategy raised approximately $17.06 billion through its at-the-market programs during 2026 through July 26th. It sold $1.28 billion of securities between July 1st and July 26th alone, but purchased no additional Bitcoin during that period. That tells us the priority has changed. The company is no longer using every available dollar to accumulate Bitcoin. It is supporting the financial instruments it previously issued. This is not necessarily a failure. It may be exactly what prudent management requires, but it changes the character of the trade. Strategy is no longer simply a leveraged Bitcoin accumulator. It is increasingly becoming a capital management business built around a large Bitcoin reserve and a complex ladder of preferred securities. That means investors have to understand the securities themselves, not merely believe in Bitcoin. Strategy disclosed that it has sold approximately $218.4 million of Bitcoin during 2026 to fund a portion of its preferred stock dividends. The board has also authorized additional Bitcoin sales to replenish the dollar reserve, pay dividends and interest, and fund repurchases of common or preferred securities. This is one of the most consequential developments in Strategy's history. For years, the entire narrative was built around one phrase: never sell your Bitcoin. Strategy has now sold Bitcoin. The company has not abandoned its broader thesis, and the amount sold is small relative to its total holdings, but the psychological barrier has been crossed. Bitcoin is no longer treated as an untouchable asset under every circumstance. It has become an asset that may be monetized to support the wider capital structure. That is precisely what critics of the preferred stock strategy worried about. The preferred securities may be perpetual in theory, but their dividends require real cash. If capital markets remain open and Strategy's common stock trades at a healthy premium to net asset value, the company can issue new securities to fund those obligations. If that premium collapses, new issuance becomes more dilutive and less attractive. At that point, the company has three broad choices: use the existing dollar reserve, issue securities under less favorable terms, or sell Bitcoin. We are now seeing all three become part of the operating playbook. This does not mean Strategy is about to liquidate its Bitcoin treasury. It means the Bitcoin treasury is not legally or economically isolated from the liabilities created above it. Bitcoiners sometimes describe Strategy as though common shareholders own a clean, proportional slice of 843,775 Bitcoin. They do not. They own the residual claim after debt, preferred equity, dividend obligations, corporate expenses, taxes, and other liabilities. That distinction did not matter much while Bitcoin and Strategy stock were rising together. It matters greatly now. Strategy increased the stretch dividend rate to 12% and said it intends to maintain that rate until the shares trade sustainably near the $100 stated value. Between July 20th and July 26th, the company repurchased approximately 28.9 million of Stretch, stated value for 25 million, paying an average price of $86.53. Strategy has approximately 975 million remaining under its digital credit repurchase authorization. This is where the preferred stock experiment becomes especially revealing. The original pitch was that Stretch could function as a relatively stable, high-yielding instrument backed by Strategy's Bitcoin-rich balance sheet. But the market has been demanding a much higher yield. A security with a $100 stated value and 12% dividend that trades in the high 80s is offering a current yield well above 12%. That is the market communicating that the perceived risk is materially greater than the stated coupon alone suggests. Strategy's decision to repurchase Stretch below par makes financial sense. Every share retired at a discount reduces future dividend obligations and captures immediate value for the company. But notice what's happening. Strategy raised capital by issuing the security. The security subsequently traded at a discount. Strategy increased the dividend. The security continued trading below par. Strategy is now using capital to buy it back. This is not the frictionless perpetual capital machine many investors imagined. It is capital structure management under stress. That does not mean the experiment will fail. Strategy has an enormous Bitcoin reserve and substantial liquidity. It may successfully stabilize Stretch, retire shares cheaply, and emerge stronger when the Bitcoin recovers. But investors should be clear about what they own. Stretch is not a savings account, it's not a money market fund, and it's not Bitcoin. It is a deeply subordinated corporate preferred security whose value depends upon Strategy's liquidity, market access, management decisions, and the continuing value of its Bitcoin holdings. The yield is high because the risk is real. Next up, exchanges, ETFs, and the institutional market. Coinbase reported a net loss of approximately $359.5 million for the second quarter. Total revenue fell to roughly $1.22 billion. Transaction revenue declined to approximately $599 million, and subscription and services revenue fell to about $555 million. Coinbase's transaction revenue was down approximately 21% from the previous quarter, and the company has now recorded 3 consecutive quarterly losses. The Coinbase report reinforces something we have discussed repeatedly. Institutional adoption does not eliminate crypto cyclicality. Coinbase has diversified beyond retail trading. It earns custody fees, stablecoin-related revenue, subscription income, and institutional trading revenue. It has become a critical piece of American digital asset infrastructure. But trading activity still matters. When prices fall, speculation cools, and retail investors lose interest. Lower trading volumes reduce transaction revenue. Lower asset prices can also reduce custody and staking-related income. Coinbase's growing subscription business makes the company more resilient than it was in 2021. It does not make the company counter-cyclical. The other important signal is that the wider industry is increasingly shifting towards stablecoins, tokenized securities, perpetual futures, and on-chain financial products. Coinbase wants to become an everything exchange. That may be sensible corporate strategy, but Bitcoiners should recognize the difference. The institutional crypto industry increasingly views Bitcoin as one product among many. Its primary objective is not monetary reform. Its objective is transaction volume. Wall Street does not necessarily care whether customers are buying Bitcoin, trading tokenized equities, earning stablecoin rewards, speculating on perpetual futures, or cycling through meme coins. It cares about that the customer keeps trading. That's why Bitcoin and the crypto industry remain overlapping but fundamentally different phenomena. Bitcoin seeks to reduce trusted intermediaries. Coinbase seeks to become the dominant intermediary. Both can prosper, but they're not pursuing the same mission. Spot Bitcoin ETFs ended the prior week with approximately 465 million of outflows on Thursday and Friday, breaking a 7-day inflow streak. Despite those late week withdrawals, the products still recorded roughly 33.8 million of net inflows for the full week, making a third consecutive positive week after 8 straight weeks of outflows earlier in the year. The number is modest, but the behavior is interesting. ETF investors have not completely capitulated. The products experienced a historic drawdown from Bitcoin's 2025 high, yet aggregate flows have been much more orderly than many people expected. This supports the argument that ETF holders are not exclusively short-term tourists. Some are financial advisors allocating small percentages of diversified portfolios. Some are institutions building positions gradually. Some are long-term investors who simply prefer brokerage account exposure over self-custody. At the same time, ETFs make Bitcoin easier to sell. A self-custody holder may need to retrieve a hardware device, construct a transaction, move coins to an exchange, wait for confirmations, and then execute a sale. An ETF holder clicks one button. That liquidity is beneficial, but it changes market behavior. The ETF structure reduces friction in both directions. During euphoric periods, that may accelerate inflows. During fearful periods, it may accelerate outflows. The key market question is no longer simply how much Bitcoin the ETFs hold. It is whether new demand can consistently absorb selling from older holders, miners, treasury companies, and leveraged investors. So far, the answer is mixed. NYDIG's second quarter review warned that Bitcoin derivatives were rebuilding leverage, even while the spot market remained weak. The report noted positive funding rates and rising open interest near cycle lows, while ETF flows and stablecoin activity failed to provide strong confirmation of underlying demand. NYDIG argued that this combination creates a vulnerability to another liquidation-driven decline. This is classic crypto market behavior. After a large decline, traders begin anticipating the bottom. They open leveraged long positions because they want maximum exposure to the rebound. But if spot buyers are not present, the market becomes structurally fragile. A modest price decline triggers liquidations. Those liquidations create forced selling. Forced selling pushes the price lower, triggering additional liquidations. That's how a seemingly stable range can suddenly collapse. There's also a broader psychological lesson. Many investors say they're long-term believers, but they structure their positions so they cannot survive short-term volatility. That is a contradiction. Bitcoin's long-term thesis may be correct while a leveraged trader is still liquidated at the bottom. Conviction does not protect the margin account. Position structure matters. The bear market will eventually end, but nobody knows whether the final bottom occurred at 62,000, whether it lies below 60, or whether Bitcoin will remain range-bound for another year. The objective should not be to guess perfectly. The objective should be to remain solvent. On July 31st, Bitcoin traded around $64,000 even as global equities rallied sharply. South Korea's Kospi posted an extraordinary monthly gain, and Nasdaq futures rose while Bitcoin and Ether remained weak. The broader CoinDesk 20 index still posted a positive July, but Bitcoin's inability to participate fully in the equity rally demonstrated that the asset is currently dealing with its own internal supply and sentiment problems. Bitcoin is often described as a high beta technology asset. Sometimes it behaves that way. Other times it behaves like digital gold. And during periods of crypto-specific stress, it can decouple from both. That flexibility frustrates investors who want a simple model. They ask whether Bitcoin is risk on or risk off. The answer is that Bitcoin is a globally traded monetary asset moving through a process of monetization. Its correlations change depending on market structure, liquidity, ownership, leverage, and macroeconomic conditions. In the short term, Bitcoin can sell off alongside technology stocks. It can also sell off while technology stocks rally. The absence of a stable correlation does not disprove the long-term monetary thesis, but it does mean that Bitcoin is not a reliable short-term hedge against every market disturbance. That is especially true in a bear market where distressed holders are selling into weak demand. Next up, macro debt and the Federal Reserve. The Federal Open Market Committee voted 9-3 to maintain the federal funds target rate range at 3.5 to 3.75%. The Federal Reserve also maintained the interest rate paid on reserve balances at 3.65%. The vote itself was more divided than we have become accustomed to seeing. 3 dissents signaled disagreement over the appropriate path of monetary policy, even though the committee ultimately chose to hold rates steady. For Bitcoin, the most important issue is not whether the Fed cuts at the next meeting. It is whether monetary conditions remain restrictive while the federal government continues borrowing at an extraordinary pace. Bitcoin has spent much of 2026 caught between two opposing forces. On one side, high rates and strong real yields make cash and government securities more attractive. They tighten financial conditions and reduce speculative liquidity. On the other side, the fiscal position of the United States continues to deteriorate, strengthening the long-term case for scarce monetary assets. That creates a strange environment. The short-term price of Bitcoin can remain under pressure precisely while the long-term reason for owning Bitcoin grows stronger. This is difficult psychologically because investors expect the market to validate their thesis immediately. Markets do not work that way. An unsustainable fiscal trajectory can continue for years. A government can finance enormous deficits as long as buyers remain willing to absorb its debt. The break does not necessarily arrive as a single dramatic event. It may appear gradually through higher yields, financial repression, currency depreciation, changing reserve behavior, or persistent inflation above the official target. Bitcoin does not need the dollar to collapse. It merely needs the dollar to continue losing purchasing power over time. During his press conference, Federal Reserve Chair Kevin Warsh emphasized a less interventionist communication style and portrayed the Fed more as a referee than a central player in financial markets. Market participants have criticized the approach as unclear, especially because the central bank remains one of the most influential forces affecting global asset prices and credit conditions. The referee metaphor is appealing. It suggests neutral rules, limited intervention, and market discipline. But the Federal Reserve is not merely observing the game. It sets the benchmark short-term interest rate, it determines the interest paid on reserves, it manages the size and composition of its balance sheet, it can create emergency lending facilities, its forward guidance affects currencies, mortgages, equities, sovereign bonds, commodities, and credit spreads across the world. That is not a referee. That is the most powerful player on the field. Warsh may genuinely want markets to become less dependent on Fed guidance. That would be healthy. But after decades of intervention, markets cannot instantly return to genuine price discovery. The existing system was built around central bank liquidity. Asset prices, government borrowing, corporate debt, housing affordability, and bank balance sheets all reflect that history. The Fed cannot easily withdraw without revealing how dependent the entire structure has become. Official Treasury data showed total federal debt reaching approximately $39.8 trillion by the end of July. Contemporary analysis estimated that the federal government has recently been adding debt at a pace equivalent to billions of dollars per day, while net interest expenses continue climbing toward levels that compete with the government's largest spending programs. This is the part of the macro story that matters most. The United States does not have to default in nominal dollar terms. It issues the currency in which the debt is denominated. The greater risk is that the debt is repaid with dollars that purchase less. That can happen through persistent inflation, negative real rates, yield curve control, regulatory pressure on institutions to hold government debt, or direct monetary financing during a crisis. Politicians will describe these policies using technical language. Bitcoiners should recognize the underlying transfer. Savers hold currency in government bonds. The currency is diluted. The purchasing power of the savings declines. The government's debt becomes easier to service in real terms. That's a tax without an explicit vote. The important signal this week was that gold and Bitcoin were increasingly discussed together as beneficiaries of the debasement trade. Bitcoin remains far more volatile than gold, and gold has held up much better during this particular bear market, but both assets are responding to the same structural concern. The supply of government liabilities can expand without meaningful limitation. The supply of gold expands slowly. The supply of Bitcoin follows a predetermined schedule that no central bank, corporation, or legislature can change. Senate Republicans released updated digital asset market structure legislation combining elements developed by the Senate Banking and Agriculture Committees. The revised text adds ethics provisions while continuing to divide oversight responsibilities between the Securities and Exchange Commission and Commodities Future Trading Commission. The industry wants clarity because regulatory ambiguity is expensive. Companies do not know which assets are securities, which activities require registration, which regulator has jurisdiction, or whether a legal business model today will become an enforcement target tomorrow. Clearer rules are preferable to regulation by lawsuit. But Bitcoiners should not assume that every bill carrying the word clarity advances financial freedom. Market structure legislation can also become the vehicle for expanded identity requirements, transaction monitoring, intermediary licensing, data retention, and government surveillance. The wider crypto industry is willing to accept substantial compliance burdens in exchange for access to the regulated financial system. Large exchanges can absorb those burdens. Banks can absorb them. Institutional custodians can absorb them. Small developers and privacy-focused tools may not be able to, and that creates a predictable dynamic. Regulation is presented as consumer protection. The largest incumbents help shape the rules. Compliance costs rise. Smaller competitors disappear. The surviving companies become easier for the state to monitor and control. Bitcoin itself may remain legal and widely held while its practical use becomes increasingly permissioned at the edges. That is the surveillance risk we should be watching. The question is not merely whether Congress labels Bitcoin a digital commodity. The question is what obligations attach to wallets, nodes, developers, stablecoin issuers, miners, brokers, decentralized protocols, and ordinary users. Despite the release of new language, the Clarity Act faces substantial political obstacles. Democrats have raised concerns over ethics provisions and the Trump family's extensive crypto business interests. Traditional banks are also opposing certain stablecoin provisions because interest or rewards on stablecoin balances could draw deposits away from the banking system. Several analysts have reduced their estimates of the legislation's likelihood of passing before the midterm election. The banking opposition is especially revealing. Banks argue that if stablecoin issuers or crypto platforms can pay attractive yields, deposits may leave community banks, reducing funds available for lending. That concern is understandable, but it also exposes the subsidy built into the current system. Banks receive customer deposits, invest or lend those funds, and often pay depositors a fraction of the yield the bank earns. Stablecoins and tokenized money market products threaten that spread. Rather than compete by paying depositors more, the banking sector naturally prefers regulations limiting the alternative. This is not primarily a Bitcoin issue because Bitcoin is not a yield-bearing dollar product, but it illustrates how incumbents use regulation to defend existing privileges. The same pattern can eventually affect Bitcoin custody, payments, and lending. The industry will frame the debate as innovation versus safety. The deeper debate is over who gets to intermediate money. The SEC's Crypto Task Force continues reviewing proposals related to tokenized securities, automated market makers, custody, disclosures, and potential temporary exemptions while more durable rules are developed. Recent submissions have addressed issuer-sponsored tokenization and the role of existing market infrastructure such as the depository trust company. This is where the line between crypto and traditional finance is rapidly disappearing. The future financial system may involve stocks, bonds, private credit, money market instruments, and real estate claims represented as tokens and traded around the clock. That may improve settlement and reduce certain administrative costs. It may also create a system with unprecedented surveillance. A tokenized security can carry embedded restrictions. It can be frozen, it can be limited to approved addresses, it can be automatically report transactions, it can enforce jurisdictional rules at the asset level. It can create a financial environment where ownership exists only through continuing permission from the issuer or regulated platform. Bitcoin offers the opposite model. Possession of the key controls the asset. There's no transfer agent. There's no issuer to update the ownership register. There's no administrator who can reverse settlement. That is why tokenization should not be confused with decentralization. Putting a traditional asset on a blockchain does not eliminate trust. It can make the trusted system more efficient. It can also make the trusted system more controlling. Next up, mining, energy, and the AI pivot. Bitcoin mining difficulty has fallen approximately 19% from its late 2025 peak, as weaker Bitcoin prices and compressed mining revenue have forced less efficient operators offline. Daily miner revenue at the end of July was approximately $34 million, down substantially from the prior year. Publicly traded miners reportedly sold more than 32,000 Bitcoin during the first quarter of 2026 to fund operations, debt payments, and expansion. Difficulty adjustment is one of Bitcoin's most elegant features. When miners shut down, blocks initially arrive more slowly. The protocol then lowers the difficulty. The remaining miners become more profitable. No committee meets, no regulator grants relief, no mining company votes on the new terms. The network automatically adapts. This does not mean miners are financially healthy. Many are clearly under stress. The halving reduced the block subsidy to 3.125 Bitcoin. Bitcoin's dollar price then declined. Energy, construction, debt, and equipment costs did not disappear. Mining is a brutally competitive commodity business. The operators with the cheapest energy, most efficient machines, strongest balance sheets, and most flexible power agreements survive. The rest sell equipment, dilute shareholders, sell Bitcoin reserves, or leave the network. From the perspective of the protocol, this is not a crisis. It is the market reallocating hash rate toward more efficient operators. The risk is concentration. If financial pressure disproportionately eliminates smaller miners, hash rate may consolidate among large publicly traded companies, sovereign-backed operators, and energy producers. Bitcoin remains censorship resistant because no single miner controls the network. Maintaining a broad and geographically diverse mining base therefore matters. And I'm talking to you, BitMEX operators such as myself. Several public miners rallied this week, not because mining economics improved, but because investors are valuing their access to electricity, land, data center infrastructure, and grid interconnections as potential artificial intelligence assets. Companies including Iron and Core Scientific have emphasized high-performance computing and AI hosting agreements, while miners across the sector continue redirecting power capacity away from Bitcoin mining when AI customers offer more attractive economics. This is one of the most important structural changes in mining. For years, Bitcoiners argued that mining was the buyer of last resort for stranded and underutilized energy. That remains true, but AI data centers are now competing for many of the same resources. AI customers may sign long-term contracts, provide financing, and offer more predictable dollar revenue than Bitcoin mining. A miner with access to scarce power may determine that the highest value use of the site is no longer hashing. From the company's perspective, that decision is rational. From Bitcoin's perspective, it changes the competitive landscape. Mining companies may increasingly become energy and data center companies that mine Bitcoin only when Bitcoin offers the best return. That flexibility can strengthen their balance sheets. It can also reduce their ideological commitment to the network. This is not necessarily harmful. Bitcoin does not require miners to believe in Bitcoin. It requires them to follow the economic incentives of the protocol. But the shift may weaken the old assumption that public miner stocks are simply leveraged Bitcoin exposure. A company whose valuation depends primarily on AI hosting contract may rise while Bitcoin falls. It may also reduce Bitcoin mining activity even while its stock performs well. Investors should evaluate the actual business rather than relying upon the word miner. Ionic Digital, which operates Bitcoin mining and AI infrastructure, began trading on NASDAQ through a direct listing and received an initial valuation of approximately $2.25 billion. The shares opened below NASDAQ's reference price, reflecting investor concern about both Bitcoin mining economics and the heavy capital requirements of AI infrastructure. Ionic's listing represents the convergence we just discussed. The company emerged from the Celsius bankruptcy process, inherited mining assets, and is now pitching the market on both Bitcoin and AI. That hybrid story may eventually work, but it also risks becoming a narrative designed to attract whichever pool of capital is currently most enthusiastic. During the bull market, every company wanted to become a Bitcoin treasury company. Now every miner wants to become an AI data center company. The underlying question remains the same. Can the business generate durable cash flow without constant access to new capital? Electricity infrastructure is valuable. Grid connections are valuable. Data center sites are valuable. But converting a mining facility into institutional-grade AI infrastructure requires additional capital, cooling, networking, specialized hardware, and long-term customers. The transition is not automatic. Next up, let's look at exchanges, sanctions, and the end of an era. The European Union included the HTX exchange in its latest Russia sanctions package, imposing restrictions tied to allegations that the platform facilitated activity connected to the Russian financial system. Subsequent reporting suggested HTX was rapidly creating new account structures and using operational tactics that could complicate sanctions enforcement. This story demonstrates the tension between permissionless networks and centralized exchanges. Bitcoin transactions can occur without an exchange. HTX cannot operate at scale without banks, internet infrastructure, employees, corporate entities, counterparties, liquidity providers, and customers who remain vulnerable to legal pressure. Governments may struggle to stop individuals from transferring bearer assets directly. They have far more leverage over large intermediaries. This is why exchanges become natural enforcement points. The state may not be able to prevent a transaction from being included in a block, but it can prevent a regulated exchange from converting the asset into euros or dollars. It can sanction addresses. It can pressure stablecoin issuers to freeze balances. It can prohibit banks from servicing the platform. The practical freedom offered by Bitcoin, therefore, depends partly upon the user's ability to operate outside centralized choke points. That means self-custody, peer-to-peer markets, privacy tools, open source software, and a healthy mining network are not fringe concerns. They are what preserve the permissionless nature of the system. BitMEX announced that it will cease operations on September 23, 2026, and urge customers to close positions and withdraw their assets. The exchange, launched in 2014, played a major role in the development of Bitcoin derivatives and popularized the perpetual swap. By the time of the shutdown announcement, however, its reported market share had fallen to a fraction of 1%. This is the end of an era. BitMEX was once one of the most influential venues in the entire Bitcoin market. Its high leverage derivatives helped shape price discovery, trading culture, and some of the most violent liquidations Bitcoin has ever experienced. It was also a product of an earlier crypto environment. Exchanges operated offshore, compliance was minimal, founders cultivated rebellious public personas, customers accepted counterparty risk in exchange for leverage and access. That model has largely disappeared. The modern industry is becoming more institutional, more regulated, and more integrated with traditional finance. Coinbase is a public company. BlackRock operates a Bitcoin ETF. Banks provide custody. Stablecoin issuers own enormous portfolios of government debt. The casino did not disappear. It moved inside the financial system. BitMEX's closure should also reinforce the oldest rule of Bitcoin. Do not leave long-term savings on an exchange. Even a famous exchange can shrink. Even a profitable exchange can change strategy. Even a platform that survives hacks and regulatory pressure can eventually close. Withdrawals are open until the day they are not. Next up, the rise of alternative crypto treasuries. Bitmine disclosed that it held approximately $5.79 million, 5.7 million Ether as of July 26th, representing nearly 5% of the reported Ether supply, along with 208 Bitcoin, cash, and several private investments. This is worth noting because the corporate treasury trend has expanded beyond Bitcoin. Bitcoin treasury companies originally offered investors a way to obtain leveraged exposure to a scarce non-sovereign monetary asset. The model is now being copied using Ether and other tokens, but the investment thesis is fundamentally different. Bitcoin has a fixed 21 million supply cap, no central issuer, no staking yield, and no governing foundation, with the ability to change monetary policy. Ether is a programmable network asset whose issuance, staking rules, fee structure, and technical roadmap continue to evolve. A company accumulating 5% of the Ether supply is therefore not simply copying strategy. It is creating a large, concentrated bet on the governance, economic, staking structure, and future utility of Ethereum. The treasury company structure can also distort markets. A public company raises capital, buys the token price rises, the company's net asset value rises, investors bid up the stock, and the company raises additional capital. That reflexive loop works beautifully on the way up. The reverse loop is much less pleasant. The bear market is now testing the Bitcoin treasury companies. Eventually, it will test the imitators as well. Moving right along to the Bitcoin podcast universe. Several themes this week. Theme 1 is the bear market near its end. On What Bitcoin Did, Corey Clipston appeared in an episode titled Bringing Back the Bitcoin Bull Market. Clipston argued that ETFs made Bitcoin easier to buy, but also easier to sell. He emphasized the difference between financial exposure and genuine on-chain ownership, and suggested that long-term holders may ultimately be establishing a floor beneath the market. This fits directly with what we observed in the ETF flows. The ETF holders have not completely capitulated, but the products add liquidity in both directions. The durable floor will not necessarily be set by a Wall Street narrative. It will be set by people willing to purchase Bitcoin, withdraw it, and hold it through a prolonged period of disappointment. Bull markets are exciting. Bear markets determine ownership. Next theme, the Coldcard failure changes the security conversation. TFTC released an emergency episode titled Coldcard is Compromised, What You Need to Do Now. That episode focused on the vulnerability, the affected users, and the urgent need for owners to identify vulnerable keys and migrate funds safely. The broader theme across Bitcoin media was the difference between owning a trusted device and building a resilient system. The Coldcard incident may accelerate adoption of multi-signature key rotation, device diversity, and more rigorous verification of seed generation processes. It may also produce an overdue conversation about how much users are expected to trust hardware manufacturers. Bitcoin removes the need to trust a central monetary authority. It does not eliminate all trust from the physical world. We still trust devices, software, entropy sources, supply chains, operating systems, coordinators, and our own procedures. The objective is not to achieve zero trust. The objective is to minimize, distribute, and verify trust. Theme 3, rates may need to remain higher. TFTC featured Michael Howell and Yields Must Rise, Fed Must Hike. The discussion centered on liquidity, inflation, bond market pressure, and the possibility that monetary policy may need to remain tighter than risk asset investors expect. This aligns with the Federal Reserve's decision to hold rates at 3.5% to 3.75%. Bitcoiners are accustomed to expecting the central bank to rescue markets. That expectation may eventually prove correct, but the timing is uncertain. The Fed can remain restrictive longer than leveraged investors can remain solvent. The federal government can simultaneously run enormous deficits while the central bank maintains high short-term rates. That combination increases Treasury interest expense, stresses borrowers, and creates the conditions for a future intervention. But future intervention does not mean next month. Theme 4, the private credit system may be the next fault line. Marty Bent also spoke with Dave Collum in an episode titled The Private Credit Bomb is Coming. The conversation examined leverage, opaque lending, weak underwriting, and the migration of risk from regulated banks into private credit vehicles. Private credit has expanded partly because post-2008 bank regulation pushed certain lending activities outside the banking system. That did not eliminate the risk, it relocates it. The key question is who ultimately holds the losses when the defaults rise. Pension funds, insurers, endowments, family offices, and retail-oriented funds may believe they own stable income-producing assets. But many of those loans have never been tested through a deep recession. Bitcoin is not directly tied to private credit. It will nevertheless react to any broad liquidity event. During the initial panic, investors sell liquid assets. Bitcoin is liquid. Later, if authorities respond with monetary expansion, the long-term Bitcoin thesis may strengthen. But the sequence matters. Theme 5, Bitcoin as a peaceful revolution. TFTC's conversation with Average Gary was titled Bitcoin is the Peaceful Revolution. The episode returned to Bitcoin's cultural and philosophical foundation, voluntary participation, personal responsibility, peaceful resistance, and the gradual construction of an alternative money system. This was a useful counterweight to the week's heavy financial news. Bitcoin is not only an ETF flow, it is not only Strategy's balance sheet, it is not only a mining difficulty adjustment, it is a set of rules that anyone can verify and no individual can change. The revolution is peaceful because participation is voluntary. People can leave fiat gradually, they can save in Bitcoin, they can run nodes, they can mine, they can build businesses, they can educate others, or just simply hold their keys. No permission required. Theme 6, Open Source AI and Bitcoin Native Agents. TFTC published Open Source AI is non-negotiable, and on August 2nd, give your agent a Bitcoin wallet. The intersection of Bitcoin and artificial intelligence is becoming a major subject. AI agents may eventually require native internet money. They cannot easily open traditional bank accounts, provide government identification, sign paper agreements, or wait for banking hours. Bitcoin and Lightning offer a globally accessible settlement system that software can use directly. But the freedom implications cut both ways. Closed AI models controlled by a small group of corporations could become unprecedented tools for surveillance, persuasion, and censorship. Open source AI offers a counterbalance. Bitcoin provides open money. Open source AI may provide open intelligence. The combination could become an important layer of future digital sovereignty. And finally, Theme 7, European Bitcoin Adoption. On Coin Stories, Natalie Brunel spoke with Julian Leiniger, co-founder of the Bitcoin-only European exchange, Rely, in an episode recorded at BTC Prague. The discussion focused on European adoption, Bitcoin-only business models, regulation, and the growing demand for alternatives to the continent's increasingly controlled financial system. Europe remains a fascinating Bitcoin environment. It has strong privacy traditions and deep skepticism toward inflationary monetary policy. It also has aggressive financial regulation, extensive reporting requirements, and a growing desire to control digital transactions. That combination creates both demand for Bitcoin and pressure against its permissionless use. Next up, let's talk about the featured Bitcoin Fortress Substack post this week. This week's post is week 11 of the Bitcoin Way of Life series entitled Building Instead of Extracting. The essay begins with a simple distinction. There are two ways to move through life. One asks, what can I get? The other asks, what can I build? Both people may work hard, both may become successful, both may accumulate wealth, but they're playing very different games. The extractor looks for existing value to capture. The builder attempts to create value that did not previously exist. That distinction extends far beyond business. Teachers build minds, parents build future generations, writers build ideas, farmers build harvests, craftsmen build objects that endure, friends build relationships one conversation at a time. Civilization itself is the accumulated result of ordinary people choosing to create rather than merely consume. Consumption is not inherently wrong. All of us benefit from things we did not personally create. We eat food we did not grow, drive on roads we didn't pave, use technologies we didn't invent, and live inside institutions built by previous generations. The problem begins when consumption becomes our only contribution, when we expect to receive without serving, to harvest without planting, to benefit without creating. The essay argues that extraction is not always financial. It can involve chasing attention without substance, seeking status without character, demanding recognition before earning trust, or criticizing endlessly without attempting to improve anything. Modern technology has made these temptations easier. Clicks are easier than craftsmanship. Outrage travels faster than wisdom. Shortcuts are more visible than decades of patient work, but builders think differently. They ask, what problem can I solve? How can I help? What can I improve? The essay connects this builder mentality to sound money. When the future becomes more predictable, people can think beyond the next paycheck, election, quarter, or market cycle. Saving becomes rational. Planning becomes worthwhile. Craftsmanship becomes valuable. Patience becomes an advantage. Sound money encourages ownership, and ownership encourages stewardship. Stewardship changes the way we treat businesses, communities, families, relationships, and our own lives. The essay contains one line that summarizes the entire concept. Extraction often wins the day, building often wins the decade, perhaps even the century. That's also a useful way to think about Bitcoin. Many people enter Bitcoin hoping to extract a quick profit. Some eventually discover that Bitcoin asks them to build savings, knowledge, technical competence, patience, stronger security, businesses, parallel institutions, or a life that is less dependent upon political promises and fragile intermediaries. The greatest builders may never become famous. The carpenter, mechanic, nurse, teacher, parent, coach, neighbor, and small business owner may never appear in a history book, but civilization rests on their work. The essay ends with a question. We're all living inside a civilization built by people we will never meet. Will the people who come after us be able to say the same thing about us? You can read Building Instead of Extracting at the Bitcoin Fortress Substack link in the show notes, along with everything else we covered this week. Before we close, I want to remind everyone that there are now 4 Bitcoin Fortress books available. The first, Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners, is the starting point. It explains what Bitcoin is, why it matters, how it works, and how someone can begin building a position without becoming overwhelmed by technical language. Next, Bitcoin Retirement and Estate Planning. This book focuses on the long-term responsibilities that come with owning Bitcoin. It covers retirement planning, inheritance, custody, estate considerations, and the practical problem of making sure your family can recover the Bitcoin if something happens to you. This week's Coldcard story reinforces why those systems matter. Owning Bitcoin is only the beginning. The Bitcoin must remain secure, recoverable, and transferable across generations. Third book is The Bitcoin Lifestyle. That book explores what happens after someone understands Bitcoin. Bitcoin begins influencing how we think about time, consumption, debt, health, patience, work, relationships, and personal responsibility. And finally, the newest book, The Architecture of Money, which examines how the modern monetary system was constructed. It covers the end of the gold standard, debt expansion, central banking, inflation, political incentives, financial repression, and the mechanisms through which purchasing power is transferred from savers to debtors and governments. The central argument is that our financial problems are not random accidents, they are products of the architecture. When a system rewards debt creation, monetary expansion, short-term political promises, and the continuous erosion of purchasing power, We should not be surprised by the outcomes. Bitcoin offers an alternative architecture with its rules known, supply limited, issuance predictable, ledger auditable. Its settlement does not depend upon the credibility of a politician, banker, corporation, or central bank. All 4 books available on Amazon, links in the show notes, and a small teaser for the next one, the Bitcoin Way of Life series, has now explored the philosophical side of Bitcoin, discipline, responsibility, solitude, gratitude, service, ownership, and building rather than extracting. The next book may bring those ideas together into a broader examination of what it means to live sovereignly in an increasingly centralized world. Not merely financial sovereignty, a sovereign life. That project's still taking shape, but I'm excited where it may lead. Well, folks, that's going to wrap up episode 227 of the Bitcoin Fortress podcast. This was a difficult but revealing week. The Coldcard vulnerability reminded us that hardware is not the security model. Strategy's earnings, it reminded us that financial engineering works differently in a bear market than it does during a bull market. Coinbase reminded us that institutional infrastructure remains deeply cyclical. The Federal Reserve reminded us that high rates can coexist with fiscal recklessness. The Clarity Act reminded us that regulatory certainty can arrive bundled with surveillance and incumbent protection. The mining industry reminded us that energy follows the highest bidder, and BitMEX reminded us that no exchange is permanent. Bitcoin continues building blocks. It does not know the price is down, or that Strategy reported an $8 billion loss, or that a hardware manufacturer made a serious mistake, or that Congress is debating market structure, or that miners are redirecting power towards AI. Every 10 minutes on average, Bitcoin processes another block of valid transactions according to rules that remained unchanged. And that is the foundation. Everything else is infrastructure built around it. Some of that infrastructure will endure, some of it will fail. Our responsibility is to understand the difference. As always, none of this is financial legal advice. This podcast is for education and entertainment only. Do your own homework. Understand what you own. Protect your keys. Avoid unnecessary leverage and build a system designed to survive. Thanks for listening. Until next week, continue to build your Bitcoin fortress, and always remember freedom, health, and positivity. Talk to y'all next week.